dollars in reserves available, and there are over $3 trillion being traded in the repo markets right now every night. So that means that more dollars are being traded every night than actually exists to be traded. How is this possible? I don't know.
I don't know.
Could be the numbers are off. Could be that something else is happening that I don't really understand yet. But you know what? Gold is at 4,000. Silver is at 48.50. When you look this good, you don't need to know anything.
Hey, when you look this good, you don't have to know anything.
But anyway, more about that on the Endgame Investor on Substack, and I will try to figure out the mystery here. But either way, this is not going to continue. I don't know how much longer it has, but if we go to the COMEX, what is going on with COMEX silver? This is the silver supply going back to 1971, looking for any kind of pattern,
implying that both metals are undergoing a period of historical transformation. Farber underscored that the prices of gold and silver are not merely indicative of market exuberance, but rather of a more profound structural shift in global finance as they approach the $4,000 mark and $50 respectively. He emphasized the unprecedented accumulation of silver stocks in COMEX vaults, which have multiplied in size since 2024. However, a significant portion of that silver is still ineligible for trade due to its storage by large, undisclosed entities. Farber interprets this as a sign that major players are discreetly removing physical metal from circulation, signaling distrust in paper markets and preparing for a revaluation event as the dollar weakens and traditional credit systems unravel. Farber asserts that the silver pattern is unparalleled in contemporary history. In the past, there was a consistent pattern of increasing inventories and declining prices. However, this time, the two are rising simultaneously, a rare and significant divergence. This dual action implies that tangible silver is being accumulated for strategic purposes rather than for short-term profit. As credit tightens and fiat-based collateral becomes unstable, silver is reclaiming its ancient status as a form of true money, he observes. Farber cautions that the world will return to tangible assets as the primary medium of exchange once the dollar's credibility collapses. In this scenario, silver's industrial significance, liquidity, and divisibility will render it indispensable. He perceives the present accumulation trend as the precursor to a monetary transition, which could accelerate the ascent of silver to triple-digit levels beyond the expectations of the majority. Farber anticipates a future in which the financial system's conclusion results in a significant increase in the value of both gold and silver. He contends that the current repo imbalances, unsustainable debt levels, and erosion of faith in fiat institutions will combine to precipitate a systemic upheaval, a moment when paper promises are rendered obsolete and only real money is viable. He anticipates that gold will stabilize at new record highs, potentially surpassing $5,000, and silver will enter a parabolic phase that could propel it beyond $100 per ounce when that moment occurs. Farber concludes that this reevaluation will not occur over the course of decades, but rather within a few months of the loss of confidence. We now present the excerpts from Rafi's interview. To ensure that you receive timely updates, kindly subscribe to our channel and activate the bell icon. I appreciate your assistance and hope you enjoy the video.
Covering at the Endgame Investor at Substack, and it shows how much of an idiot I am and how I'm so wrong and I don't know anything, because the daily repo volume is now over 100% of available reserves. There are about $2.966 trillion in reserves available, and there are over $3 trillion being traded in the repo markets right now every night. So that means that more dollars are being traded every night than actually exists to be traded. How is this possible? I don't know.
I don't know.
Could be the numbers are off. Could be that something else is happening that I don't really understand yet. But you know what? Gold is at 4,000. Silver is at 48.50. When you look this good, you don't need to know anything.
Hey, when you look this good, you don't have to know anything.
But anyway, more about that on the Endgame Investor on Substack, and I will try to figure out the mystery here. But either way, this is not going to continue. I don't know how much longer it has, but if we go to the COMEX, what is going on with COMEX silver? This is the silver supply going back to 1971, looking for any kind of pattern that can explain what is going on with the silver supplies. You see here the spike since the beginning of 2024 from about 8,000 tons to now 16,543. The silver supplies in New York have basically doubled in 2 years. That's scary, and all this silver is going offline because a lot of it is going into cold storage, not for sale. There's some for sale. There is a good amount of silver for sale against contracts in the registered supplies, but a lot of it is ineligible, meaning it's not for sale. These are humongous whale stackers. We don't know exactly who they are, but they are piling up huge 5,000 ounce bars, and we don't know why. But if we look at these little rectangles, and I made them thin so you can see what exactly they are bracketing here. This is the 1980 run from the end of 1979 to the beginning of 1980. That is the big spike over here. What was happening in the silver supplies? They were kind of going up. They're going up appreciably, but nothing compared to what they are now. So there wasn't much of a move there because in 1971 or 1970, silver supplies were much higher than they were in 1979, 1980 in New York. So not that much of a correlation there. But here we see that as silver supplies were going up from about 1980 to 1993, you can see that the silver price was falling in a descending triangle from about the beginning here in 1983 to 1993. And around here is when, what's his name? Buffett, that guy, what's his name? Warren something. He stood for delivery of silver around here. And then the silver supply started draining, but there wasn't much move in the silver price. So we don't see much of a correlation between the silver price and the silver stacks in the COMEX vaults. Same thing in 2011, there wasn't much of a correlation at all. You can see here the move from 2010 to 2011 from it looks like about $12 to $15 or whatever it was to 50 in a matter of months. Not much movement in the silver supplies here. They went slightly down, but nothing alarming. And here is where we see what happened from 2020, from the lockdowns, those glorious medical miracles that saved all of our lives. Going down, the silver price was going down and the silver supplies were going down. But here is something that we haven't ever seen before, and that is a doubling of the silver supply with a more than doubling of the price. So this is the first time we are seeing silver stacks move up in the COMEX and the price also go vertical with it. First time we're seeing that. What does that mean? It means something new is happening here. What is happening? Well, the dollar is collapsing, and that's going to lead to silver becoming money once again, because once credit collapses, there's no other way to exchange other than with money itself, because everything else is a derivative. But where is the demand coming from? Is it the ETFs? Not really. Here is a close-up. We're going to go into the farther out, zoomed out chart in a second, so you'll see this isn't much of a climb. It is a climb. It's not much of a climb. But you can see here, the last 3 days, we've had these 3 bars over here. If you total this up, it's about 17 million ounces in 3 days have been drained from the ETF. 17 million ounces go out of the ETF, go back into the vaults, either in London or in New York. They're able to do this because there isn't that much retail demand for SLV or other ETFs. Otherwise, they would have to stack silver in the ETF to keep it in line with the silver price. The fact that this is going down means there is less demand for ETF for retail traders because they're just not interested in silver yet, because it's not going high enough fast enough, but it will. So no demand in the ETFs, no demand in the physical markets for the stackers, because as I said, I just had an interview with Brian Kuzmar, who said the spreads are far apart, which means there is no activity and no demand. Here I wanted to go into silver squeeze, but we can see here the ETF demand. The only movement that ever increased ETF demand substantially was silver squeeze, excluding this part over here, which was the post-lockdown frenzy for silver. That really was a huge move in the silver stacks. This is the amount of silver in the SLV ETF. It went up from about the lockdowns to about the middle of 2020. I think that's August 2020. And then it stayed kind of steady until silver squeeze and then fell. So if we look back at the 2010, 2011 rally to 50, we can see here there was a little bit of ETF demand, not that much. It was slight, it was appreciable, but it wasn't humongous. It wasn't anything like this, right? So we can see here that even the 2011 rally did not have much of an effect on the ETF demand. It had a little bit, but not that much. The only thing that had a big effect on ETF demand was silver squeeze. That was it. And here is the move from silver from about 27 to now 48. So about a doubling in the silver price. And here is the move in SLV from, what is it, 400 and maybe 40 million ounces to now 487. So about 40, 45 million ounces. That's not that much. There hasn't been much demand in SLV. So once these three cylinders get going, meaning physical markets and ETF markets and whoever's stacking in New York, who appears to be continuing to do that, imagine where the silver price will be then. It will be in the hundreds, and that could be relatively soon, which is why I shared an options play on the Endgame Investor on Substack for paid subscribers. And if you sign up, all of the new paid subscribers will also get that idea that you can still execute, though there isn't that much time left. U.S. real estate. I wanted to go into this in terms of gold because we broke a low here in terms of how many ounces of gold it takes to buy a single house. We broke below 120 ounces.
Vince Lanci emphasizes that gold and silver are reclaiming their status as the sole authentic forms of money in a world where trust in fiat currencies is constantly eroding. As a wake-up call, the situation in Japan is currently unfolding. Investors are not simply transitioning to dollars as they once did, as they are concerned about the potential for a devaluation of the yen. They are expanding their investment portfolio to include metals, acknowledging that this is a global issue rather than a Japanese one. Lanci elucidates that this transition signifies the commencement of a more extensive capital flight from paper promises to tangible assets, as individuals lose confidence in the government's capacity to sustain their currencies through perpetual debt and monetary manipulation. Gold's ascent beyond $3,900 and silver's ascent toward $50 are not mere speculation. Rather, they are reflective of the increasing recognition that these metals continue to serve as the most effective protection against inflation, currency debasement, and systemic instability. Lanci underscores that this moment appears to be a pivotal moment in the gradual erosion of confidence in the omnipotence of central banks. The G7 nations are all confronted with the same dilemma: spend less and endure deflation, or print more and devalue the currency. Throughout history, governments have consistently opted for the latter, which has resulted in cycles of devaluation that compel investors to return to tangible repositories of value. The realization is dawning that there is no simple solution, only a reckoning, as dread extends from Japan to Europe and beyond. In that assessment, gold and silver are re-emerging as the foundations of genuine wealth. Lanci is of the opinion that the present rally is not a temporary surge, but rather the initial phase of a structural re-evaluation. In an era in which the trust in fiat currency is rapidly diminishing, one that will redefine the true meaning of money.
The conversion to dollars historically is bearish for gold. The dollar is stronger, and gold, which is a neo-Keynesian slave to the dollar correlation, drops. But what's happening now is, and this has happened many times for moments, for 30-minute windows in the past, and that is when the fear in Japan gets big enough, the people that are taking their money out of the yen, they don't just put it in dollars. They say, you know what, I'm going to take my money out of the yen and put it into another currency. But then they realize that this isn't just a Japanese problem, it's a global problem. So they'll put less money in dollars and they'll put some money in gold. They'll put some money in other currencies, whatever. But the point is, there's a growing number of people that are skeptical on the ability of any fiat currency to withstand what's going on in Japan. What's going on in Japan has already started to happen in the UK, and it's starting to spread. And so you're in a situation now where the dollar is stronger because people are selling the yen to buy dollars, but they're not selling the yen to only buy dollars. They're selling the yen to buy gold too. And this is quite literally the manifestation of what you've been concerned about or thinking about, these past 30 years. And that is the manifestation that The markets are slowly starting to realize there is no Santa Claus. And speaking financially about it, the markets are saying, wait a minute, there is too much debt. We understand that now, and we recognize the only way out of the debt is to either bond yields have to go up because the bond yields have to compensate us more for the debt to take the risk of borrowing, or the currency has to weaken its buying power to compensate for the low yields, right? And the way to hedge both of those is to take your money out of the bond market, take your money out of the currency itself, and put your money in the companies that use the currency to make more money. Because the theory is, and the theory is largely true in normal and market environments, is that if the currency is being debased, then you can raise the prices on your goods that you're selling. So the Japanese manufacturer will have more money that he's making because people have more money to spend from inflation. So if the yen is weaker, he'll just raise the price in yen. That's a normal environment. In a bad environment, and we're not there yet for Japan, at least Japan's mentality, they realize that the companies can't raise prices fast enough to offset the debasement of the currency, and people don't have the money to actually spend because it's all being steered by the government into where they want it to go, and the companies end up suffering. But that's another conversation. So in sum, what's happening in Japan is framed as Japanese because of the new election, because the government's probably not going to play well with the neo-Keynesian governments, with the other G7s. You have a conservative prime minister coming in. And that means an acceleration of revealing that we have a problem here. That means higher yields in long-term bonds for the Japanese. That means they may have to go back to yield curve control. Depends on how they do it. I'm not sure, if they want to go back to that or try something different, something that I'm not familiar with. But the world is seeing a slow motion contagion. What happened in the UK is happening in Japan. And if it's happening in Japan, it's probably going to happen in every G7 currency to one extent or another. You can't spend more, borrow more, and expect your economy to do the same without inflation. If you stop spending, you'll have a deflationary collapse. The deflationary collapse will be most noticed in stocks. So you got to keep the pumping stocks up. That in the past worked in every government in the G7 because people believed it would work. And so gold only benefited marginally. But the belief is fading. And as the belief fades, more and more people are turning to metals. Now in Japan, that's the financial relationship of what's going on. Now, Japan itself, you're starting to see more and more headlines about Japanese dealers running out of metal, and that's been happening since July. We wrote about that, but it's going to get more headlines now. So these are realities that you've already been apprised of.
It appears that the world is on the brink of a financial turning point in which the confidence in paper money and government-backed systems begins to erode, necessitating a return to assets that possess genuine intrinsic value. Nations and investors alike are discreetly repositioning themselves for a world in which scarcity and stability are more important than speculation as the cracks in global markets widen. Record central bank gold purchases, increasing physical demand, and a growing interest in tokenized forms of tangible wealth are all indicative of this transition. Each is a step toward the establishment of a new monetary system. The next era of finance may combine ancient security with modern innovation, where gold and silver once again anchor value and digital technology assures their reach across borders, when trust in fiat inevitably falters. In this future, wealth will be quantified by assets that persist beyond economic illusion and political control, rather than printed numbers. Do you believe that the future of money will be reliant on tangible assets such as gold and silver? Alternatively, will digital currencies assume complete authority over the financial system? Please express your opinions in the remarks section below. If you find this video to be informative, please consider supporting our channel and activating notifications to remain informed about our most recent content. I will see you in the video that follows.